Morning, everybody. We have about 25 people on. We're going to give it just another minute, and we're going to get started. So just hang tight, another minute. Okay. All right. I'm going to go ahead and get started. I just want to welcome everyone. Good morning. My name is Nikki Glenn. I work for ACG Columbus. I want to welcome everybody to today's webinar. It's the M&A Market Update with Andy Hayes of Copper Run and Keith Bishop of Stonehenge Partners. Before we get started, I wanted to cover just a few things. Everyone is going to remain muted for this session, but you can ask questions. There's a question in the GoToWebinar toolbox, and sorry about that. But there's a question section where you can submit your questions, and we'll be monitoring those throughout the session. And if we have time during or after, I'll be sure and get those to Andy and Keith for answers. If you can hear me but are having technical difficulties seeing the screen or anything else, you can also email acgcolumbus@acg.org for assistance. I will be monitoring that email. To get started, before we get started, I'm going to kick things off to Amy Fleener with First Commonwealth Bank. She's one of our ACG board members, and First Commonwealth is one of our annual sponsors. So Amy's going to do a quick welcome, and then we'll get started. Amy?
Hello, thanks, Nikki. As Nikki mentioned, I'm Amy Fleener, Senior Vice President and Associate General Counsel of First Commonwealth Bank. I serve on the ACG board, and I'm a former co-chair of the Women in Transactions Committee, and my company is an ACG annual sponsor. First Commonwealth is a community bank headquartered in Indiana, Pennsylvania, with a presence across Pennsylvania and Ohio. Named by Forbes as one of the world's best banks in both 2019 and 2020, First Commonwealth's mission is to improve the financial lives of our neighbors and their businesses. We pride ourselves on handling sophisticated financing needs for commercial, industrial, and commercial real estate clients with the impeccable service and customer focus of a community bank. For those of you unfamiliar with ACG Columbus, we're one of 56 chapters of the Association for Corporate Growth, and we promote the growth and development of Columbus area businesses for the benefit of our communities and Ohio. We encourage ACG Columbus membership in order to gain insights into the Columbus business community regarding growth, acquisitions, finance, and other local business trends. Membership also enables you to network with other local members and sponsors at monthly events, social outings, and national events. ACG Columbus also offers membership opportunities to participate in our Young ACG programs and Women in Transaction events. Given the current pandemic, we're adapting to virtual programs like this one in order to provide value no matter the challenge. And we are hopeful we can return to our regularly scheduled events safely in the near future. If you would like more information about ACG membership and how you can get involved, please contact Nikki at 614-652-9928 or visit the ACG Columbus website. I'm pleased to introduce our speakers today. First, we have Andy Hayes, co-founder and president of Copper Run Capital, an investment bank focused on middle market M&A. He oversees firm strategy, operations, client services, and business development. Andy has extensive experience in investment banking, accounting, and consulting. He has started multiple businesses and worked with hundreds of separate companies, both public and private, on various engagements. Mr. Hayes previously worked for Cantor Fitzgerald's investment banking group on Wall Street, EY in Cleveland, and has been involved in more than $7 billion of completed transactions during his career. He's a registered investment banking representative and holds the FINRA Series 7, 79, and 63. He also successfully passed the CPA exam and previously worked as a CPA. And he has a bachelor's degree in accounting and an MBA from the Fisher College of Business at The Ohio State University. He's a founding member and current president of ACG Columbus, a board member of the Entrepreneurship Institute, and a member of the Aileron Center for Entrepreneurship. Also joining us is Keith Bishop, managing director at Stonehenge Partners. Mr. Bishop is responsible for negotiating transaction terms, performing due diligence, and providing analytical support for Stonehenge transactions, and for existing investments, working with portfolio company management teams and monitoring portfolio company performance. Prior to joining Stonehenge Partners, Mr. Bishop was a financial analyst with GBQ Consulting in Columbus, participating in the group's business valuation and mergers and acquisitions consulting services. Before joining GBQ, he was a senior commercial credit analyst with the Huntington National Bank. Mr. Bishop received his BA in mathematics and economics, magna cum laude, from Denison University. With that, I'll now turn the program over to Andy and Keith.
Hey, thank you, Amy, very much. We'll appreciate everybody joining. We're, as president, kind of two roles here today, president of ACG and a presenter. Thanks for joining. And obviously, as Amy mentioned, we're trying to get some good programming here that's interesting, hopefully value added to our membership, as well as try and spotlight some of our sponsors, which are, really the foundation of ACG and, help us accomplish our mission of growing businesses in Central Ohio. So, hopefully today will be interesting for you. Maybe you'll learn something. Keith and I'll try and convey our observations in the market. We have a presentation which will be available afterwards as well, that you can email Nikki and she could send out to you. We'll try and come up with, let you know what we're seeing, what we think we're going to see into the future. So kind of with that said, we'll go ahead and get started. So Nikki, you can probably flip to the first slide there if you want or you're able. But essentially in what we saw, pre-COVID, so going back to February, which seems like eons ago at this point, different time, valuations in M&A were at all-time highs. Banks were aggressively lending, private equity firms were aggressively buying. It was, and it had been like that for a couple of years. It was a great time to be a seller. Valuations were at all-time highs, record highs, really across a number of different industries. And that kind of came to a screeching halt, in the middle of March, call it, in the United States at least, and really worldwide, probably, in March as well. So, what does that all mean? What's that going to mean kind of going forward as well? We're certainly going to see more, I guess, and Keith can comment on this too. We thought we would see some pretty drastic declines in valuations. I don't know if that's still the case, and that's changing daily. A lot of deals are on hold, certainly. But just kind of overall, that was the observations going back, 3 months ago now. Keith, what did you see kind of happen right around then, that March, April time frame?
Yeah, so there's certainly pre-COVID large amounts of dry powder with private equity, a lot of strategic buyers flush with cash, as well as cheap, easy credit, fueling kind of the spike in valuations. Turning to March time period, I think the biggest driver of valuation is cash flow visibility. And we have, certainly a hard time accurately forecasting our own portfolio companies that we know very well, just with all the uncertainty out there. And we think it's just going to be harder to evaluate new opportunities or we face a steep learning curve as we evaluate, the impact of COVID on new business opportunities. I think, with that said, deal flow started to soften in March, and it's starting to pick up a little bit right now. But what we're seeing is, there's still that large amount of dry powder with private equity. Credit markets aren't quite where they need to be, but they are, improving. And I think, the scarcity of deals out there in the market could potentially create a dynamic where valuations do creep up as a result of that deal scarcity.
Yeah, that's something we'll touch on here a little further. But, Keith and I talked before this, and sitting here a month and a half ago, boy, would have said, valuations would take a pretty big hit. There's going to be a lot of distressed deals, right off the bat. But things have changed. Like, I think it's a supply and demand thing. There's a lot less deals out there, and there's still a record amount of cash, and actually more. I mean, the Fed's pumped in a few trillion more cash into the economy in the last couple of months. So less deals, more cash. Supply, demand, prices, and valuations, we think, are for good companies are going to remain very strong, or certainly pop up from maybe where they were for a short time, for a couple months. But again, that's all very fluid situation. That can change. We get a new flu out of China, and we get a huge resurgence. That can all change, or probably will change again. But yeah, Nikki, maybe flip to the next slide. Just talking about what this has all meant to the transaction process. Some deals are still getting done. We've closed a few, and I think Keith has closed a few. Most folks have closed a few, much less than normal. But negotiations are more difficult. In-person meetings are happening again, but not in a big way. People are getting on planes, but not like they were 4 months ago. We've done a few for companies we're helping to sell, and also for ones we're helping our clients buy. We've done a couple of Zoom tours through manufacturing facilities and production facilities, which is pretty good. It's probably not quite the same as having boots on the ground and kind of seeing someone eye to eye, but I think we're going to have more and more of that kind of as time goes forward. Keith, we'll let you kind of comment on some of these things, what you're seeing in the processes out there.
Yeah, I mean, I think from a seller's perspective, I think the bullet points on the right spell it out. Many sellers are fatigued with the latest pandemic and evaluating the option to sell. I can't imagine going through another crisis. The timing could be right for those businesses that performed well through the pandemic. There's this window now with deals coming out that performed well during the pandemic that should get strong interest from buyers. And I'll take the 2-minute shameless plug for Stonehenge in terms of being a partner. You don't have to sell 100% of your business. We can provide minority equity as well as control equity to help businesses effectuate meaningful growth both organically and through acquisitions. And we think there's probably here coming in the next few months opportunities where if you're a strategic buyer looking to consolidate in a market, that there could be distressed opportunities that you can take advantage of. But I think it all starts with the credit markets, and those need to return to normal, which there was an article in the Wall Street Journal today stating that the sale of the CLO, collateralized loan obligations funds, have approached March levels, still below February and much of 2019, but encouraging to see that part of the market is coming back.
Yeah, I think that's one of the points you touched on there was that the providers, the buyers, the investors like private equity or strategics, whoever they might be, are having to be more flexible on terms. I think we'll continue to see that. I think probably a number of private equity funds and businesses that have made investments in the last couple of years are doubling down on companies that are maybe fixable or have just slowed down temporarily. Maybe not so much for ones that are in sectors that we'll talk about later. We're struggling pre-COVID, quite frankly, like retail and some others. But another thing to think about too is, from our perspective, look back to 2008, 2009. As Keith said, we've gotten a number of calls from sellers that private business owners that are 60, 70 years old that they don't want to go through the 5-year rebuild again. So there will be some sellers that come to market because of that. They'd rather go spend, the next 20 years in Naples playing golf than trying to build a business back that's, revenues are down 50%. So I think we will see that certainly as well. I think you can probably go on to the next slide there, talking about some transactions out there in the market. You'll see we have a number of transactions we mentioned. Most of them are broken deals that have been in the market for the last 3 months. Obviously here locally, L Brands was under agreement with Sycamore Partners, a large private equity firm focused on the retail space, that backed out of the deal. And there was obviously lawsuits and things like that involved there. But as you can imagine, a lot of transactions have kind of broken up. And we'll touch on some more, but there have been some that have come back too. Or some deals that are happening, especially amongst technology-related companies, healthcare. So today, Uber was put a bid in on Postmates. But for every positive one, there's probably a negative, right? I also saw Cirque du Soleil is filing for bankruptcy, which is kind of sad. And then also, just on a entertainment, keep on the entertainment front, Broadway is going to close for the rest of the year, which doesn't bode well for a lot of folks in the entertainment space. So it's and we have the statistics on there in the lower right corner. Volumes are down half from what they were last year. Not a big surprise, but also the lowest 2-month period in M&A in the last 22 years. So pretty slow as well.
Yeah, and I would just add, from a timing perspective, think about 6 to 9 months to sell your business from, making the phone call to Andy. 3 to 4 months preparing, and then, the balance to go find a buyer and close on that transaction. So as the pipeline started to retreat in late March, I'm sure Andy's phone was a little lighter than usual in April, May, but probably picking up in June. So we just lost, 2.5, 3 months. So it's going to take a while for that volume to come back to normal levels. But with that said, PE, private equity, sitting on record $1.45 billion of capital in June, which is double that of 5 years ago. And there's going to be a strong desire to deploy that capital before it expires. For us over the last, 2.5, 3 months, spending a lot of time with our portfolio companies, just helping them manage through this crisis. And I think a lot of private equity firms have been doing the same, just helping their companies think through various strategies to manage best through the crisis.
Great. And Nikki, we can go to the next slide there, deal financing. So, bank debt, debt in general is kind of the rocket fuel that's fueled M&A for forever, but especially the last few years, historically low interest rates, more aggressive terms from lenders has really helped M&A. And that's, I know we have probably a number of commercial bankers on the call. That's from what we've seen, probably, and I think Keith would agree, it's slowed down, probably got a little more expensive. Banks are probably taking a much harder look at new deals, certainly, and even existing deals as well. So that'll naturally kind of slow down the process. At some point, it's going to impact valuations likely as well. But I think because of that, we're seeing probably more deals that are closing or closed with all cash. They're closing from a buyer that's flush with cash, and they will go refinance the deal later on better terms or that type of thing. Also, a number of companies, a lot of companies out there have kind of drawn down their lines of credit. Probably going back to March and April timeframe. That's a pretty common theme as well. What are you seeing out there, Keith, kind of on that front?
Yeah, I mean, I think right now, they were coming into the crisis. If there was a troubled business coming into the crisis, certainly this didn't help. So, banks have seen Q1 covenant compliance certificates. And if you're generally healthy coming into this, you probably passed covenants in Q1. I think banks are really looking for Q2 to see guidance on how COVID really impacted their portfolio. So when those covenant compliance certificates come out in late July, early August, I think banks will have a better picture of the impact across their portfolio. Generally speaking, hearing in the market that leverage might have come down 0.75 to one turn, and that pricing has increased roughly 100 basis points. We saw in the paper again this morning the record, the resurgence in CLO financings. The spreads for the AAA increased from L plus 125 to L plus 165 from February to today. So we are seeing an increase in pricing. But all that's to say, I think we're going to see banks being cautious, dipping their toes in the water here.
Yep. Okay. We can go to the next slide there, 5, Nikki. Well, hot topic, cooled down a little bit, but hot topic for a couple months there was PPP and what that's going to mean to deals. I can speak from our firm's perspective, and I know we have one deal on hold right now. The buyer wants to, ensure that the seller gets through their PPP and has, I guess, utilized it, so to speak. Their attorneys have some concerns about kind of change of control provisions and things like that, and what that'll mean for PPP. So basically on hold, for a month or so. Overall, we mentioned there, I don't think it's gonna have a material impact on M&A besides just maybe holding up some deals. But we shall see.
Yeah, I think PPP presents a really unique challenge, given all the political nature of it, with the disclosure of all the parties receiving it. Really for April, I think much of the world was learning about PPP and applying. May, there's a dribble of FAQ questions answered, but still there's just more questions in June. Not enough clarity from my perspective.
Yep. We have on there, we mentioned the Worker Adjustment and Retraining Notification Act. I guess we haven't encountered, personally from our firm, too many issues with folks that have had, mass layoffs. It certainly could be an issue, though, especially for distressed deals, which I think we'll see more of those probably later this year. But again, to be determined what it's going to mean. It's tough to tell right now, but in distressed deals, time is such a critical factor as well. We'll see if that comes into play, may or may not, in a significant way. I don't know if I know you guys don't do quite as much distressed work, Keith, but if you've looked at companies that are distressed or have had significant layoffs and what that might mean to a transaction.
Yeah, we've not had much experience, especially with the WARN Act. I will say, we deal probably a little bit more with slightly over leveraged, good businesses, but maybe a broken balance sheet. So let's say, you've through COVID, your total leverage went from 2.5 times to 4 times or 4.5 times. We've evaluated situations where we can help right size the capital structure, bring in our own subordinated debt and maybe preferred equity to help kind of alleviate the concerns that the company's experiencing with its senior lender.
Sure. And I'm sure all the senior lenders on the line today probably never want to hear the 3 letters again, PPP, because I think everyone I've talked to, that's all they did for the months of April and May, pretty much answer questions, around the clock from folks. But Yeah, and it's also going to be interesting to see what happens. A lot of companies that's starting to roll off now. PPPs, they're kind of running out, right, of PPP funds. Is there going to be a second wave of layoffs coming? Probably will be for some businesses, to be determined. But a lot of folks that were really struggling, probably in a lot of the areas we'll get to here. Retail, restaurants, hospitality, things like that. We may see some more ugliness, later this year once they run out of some of these government programs that they've probably been surviving on for the last couple of months.
Yeah, PPP seems like PPP seems like a new four-letter word for senior lenders.
Yeah, for sure. We'll get next slide. We're talking about deals under LOI and what that's meant. We can speak to some of the transactions we were involved with. We had, it's probably a third. We saw a third of the deals basically just died. They either the sellers or the buyers were dramatically impacted by a slowdown that was COVID related. So everything just went on the back burner, and some of them are probably never going to come back, and some will hopefully next year, and then a third of them are on hold but likely to come back, I would say, once things kind of get normalized, or probably a lot of times it's more sellers and buyers can come to a revised or agreement on revised terms. That's probably a big issue. And then a third of them, deals closed. Companies were a couple of things. Either the buyer really wanted to close the acquisition on current terms, even if there was some impact, or maybe seller was willing to take versus maybe a 5% escrow or something. Maybe it's a 15% escrow, or maybe as opposed to 100% cash at closing, there was introduced a 20% earnout over 12 months or 24 months or something like that, or a seller note. So folks that, on both sides want to get a little creative and try and close the deal anyway, got them done. But that was probably more the exception, I guess, than the rule, what happened there. And what did you see, Keith, and deals you were looking at when all was
hit? We had one that was, within a week or two of closing, around that March 16th time period when everything began to shelter in place. That deal we put on hold, don't have a lot of clarity. We're starting to, we're continuing to maintain contact and, evaluating kind of the business and the impact that this has had on it. So, we'll continue to look at that one. But what I did hear, we got a call in I think mid-May. There was a company, nice looking business, that they were under letter of intent pre-COVID. COVID hit, and they were in the midst of diligence with a private equity buyer. And the private equity buyer started, to try to retrade the deal, renegotiate, introduce a seller note and an earnout. And the seller, he was very convinced that there was an opportunity to consolidate the market. And with the COVID crisis, many of his competitors started calling him because they couldn't really kind of survive through this. And he decided to cut bait with the private equity buyer, and actually go out and try to raise capital just so he can consolidate the industry. So, we were looking at, helping that seller. He really kind of pivoted and turned into a buyer and wanted to find a partner to help him, execute on 5 or 6 acquisitions, which that was one of the more interesting deals that I saw in this environment.
I think that's a great point. For folks who are on the line, they're maybe buyers or sellers. Looking back at, had great fortune of starting this business in 2008, right before the Great Recession, and a lot of companies, looking back though, use it as an opportunity, right? They probably had some struggles themselves, but use it as an opportunity to do some acquisitions, to maybe bring on some talent they couldn't have afforded otherwise, or, things like that. And come 2010, 11, 12, they become a much stronger business. And now they've done very well because of that. And I think you're always going to have the same thing. Any kind of market downturn, where there's ever any issue, there's going to be some folks, smart, aggressive folks that are going to use it as an opportunity to, to really grow their business, change their market share, what have you. So I would, I know there's a lot of service providers on the line. I really do think that's an opportunity for someone that's got more of a long-term vision, 5, 10, 15-year plan. Hey, this could be an opportunity for them, especially if they're in an industry that may be distressed, later this year and going into probably 21 as well, to do some of those things. Nick, you can probably flip to the next slide there, number 7. We'll spend a little bit of time on this, to kind of a market outlook. So we'll try and look into our crystal ball here. Keith's got a better crystal ball than I do, but we'll kind of let you know what we see. I guess the way to punt on this market outlook is like, hey, we don't know. It's changing every day. But I guess, from our standpoint, as we sit here today, Copper Run, we're more optimistic than we were a month ago. As far as selling businesses, we think valuations are not going to be as bad or decline as much as we thought. For buyers, there probably will be opportunities. There will be sellers that just want to get out of their business. So that'll certainly be an opportunity. It's going to be a little hit or miss, probably for the next year. There's going to be times where things ramp up and probably things slow down. And, if we have resurgences and things like that, that'll certainly have an impact. Probably a good time if you've got I think we mentioned before, if you got a business that's you believe is just temporarily slowed down, hey, maybe it's a good time to double down on that business. If you think the outlook still remains pretty strong, it's an opportunity to do some things there. I think that's going to be really interesting. We deal with private companies for the most part. We have some public company clients, but we're not selling entire public companies. The public equity markets have just been, red hot since really end of March, beginning of April. And when Q2 earnings come out, I guess it'll be interesting to see. Personally, I think there's probably a little irrational exuberance in the market right now. I think there's probably some more pain to come with a lot of those public companies. But I've been wrong before on those things. What do you think there, Keith?
No, I completely agree. It seems like the market's way ahead of itself, just with lack of visibility. And I don't know how many public companies have pulled guidance, rightly so, just because it's hard to forecast with any degree of certainty in this environment where you see some states kind of going back into lockdown or restricting certain activities. And I think we're going to have a rolling kind of up and down based on what certain states are experiencing. I'd say expect to see more bankruptcies over the coming months. PE-owned company bankruptcies. There are 34 PE-owned bankruptcies from March 1 to June 14th, including on the slide Hertz, Neiman Marcus, J. Crew. So I think we will see a little bit more, disruptions in the market as a result.
Yeah, which leads us a little bit into we talk about bankruptcies. Again, from our perspective, I think you're seeing a lot of the really large public companies, file for bankruptcy. I think a lot of private companies have kind of been hanging on by their fingernails for a while, including a lot of industries that were struggling, quite frankly, before COVID. Probably specifically retail, oil and gas, energy related things, and then obviously now hospitality, restaurants. A lot of those things are struggling because of COVID. But it's interesting. You're looking at it from a 30,000 foot overview. A lot of the companies that are filing for bankruptcy, it probably just expedited the process, right? They were probably heading that direction because of different market forces pre-COVID. And then this hits and it just, sped everything up, Chesapeake filing for bankruptcy. We do a fair amount of oil and gas work. And, when the Utica Marcellus Shale really took off, 10 years ago, 12 years ago, they were at the forefront, right? They were the Google of the new technology for shale. And, I looked right before they filed for bankruptcy. I think their market cap, they'd done a number of reverse splits. They were down to like 100 million market cap, and I can't remember what their enterprise value was, but it was, a fraction of what it was certainly 5-10 years ago. But they were going to go bankrupt anyway, most likely. So it's certainly expedited those things. Probably an opportunity, for buyers, not yet again, but later this year, next year, in those spaces to do a consolidation, a number of areas. But it's kind of changed the outlook for the economy for a number of different businesses, and it's really, kind of interesting as well to see what is going to do well, what doesn't do well going forward.
Yeah, and I think it's early right now from the restructurings, perspective. It seems like maybe we'll start to see that restructuring activity pick up in maybe August when you get the covenant compliance certificates issued as of June. So, I think that's still going to be a lengthy process, as everyone figures out, what the real impact is from a financials perspective on your business. Another kind of point that maybe we can chat about, Andy, is just the labor pool. With the enhanced $600 unemployment benefit going through, July 25th, 26th. We are seeing that it is harder to find labor in that $15 to $20 per hour range, and that's kind of real time and certainly a challenge that presents from an expense perspective with many of our businesses.
Yeah, that's a great topic and great point, because that is a major issue for big percentage of the companies out there. Folks that laid people off that were making, again, $18 an hour, and now they're making more in unemployment. I mean, that's a whole long topic and discussion, but it's an issue. I think that's going to resolve itself in a couple months. But as we sit here today, absolutely. We hear from a number of folks that are actually doing okay, or their business is coming back, but they can't find anybody. They can't get anybody to come back to work, or can't hire anybody. But I think that's more of a temporary thing, but for sure. But it's also probably expediting a lot of companies to utilize technology more, which isn't great for the outlook for labor. But it's, again, like a lot of these things we've talked about, it's probably, moved technology enhancement. Some companies were contemplating move that forward, rapidly. So that'll change things as well. Let's see, we're about 20 minutes or 15 minutes left. Nikki, do you have any questions out there?
Yeah, we have a couple. One is, what should I be doing now to document the impact of the COVID-19 crisis to my business?
Okay, Keith, you want to handle that one?
Yeah, I'll take that. I mean, I think you really want to, if you're thinking about selling now or anywhere in the future, I think buyers are going to ask, how did you react to COVID? How did your business react to COVID? And, it's kind of the new, how did your business react to the financial crisis? I think right now you want to start documenting everything that you've done, just specific dates that you impacted strategic initiatives, whether it's headcount reductions or the like, and then start to document the financial impact that those decisions have made on the business, so that you can really kind of to provide a COVID-19 playbook that everyone can clearly see. Okay, this is what happened. This is what happened to bookings. This is what happened to revenue. This is what happened to shipments. Could I get shipments out because of maybe potential shutdowns at the plant. So I think you document that in a really tight timeline. So that way you can say, with certainty, this is what happened, this is my reaction, and this is the impact and the outlook.
Yeah,
anything to add, Andy?
I would echo that. Yeah, you, especially if it's really having an impact on your business. Yeah, here's the changes, because if you do want to sell in the next 6 months or 6 years, it's going to be a topic for discussion. Hopefully, we're 3 years out and it's ancient history by then, but people are still going to want to see how you handled it, what impact it did have. People are probably going to still be sensitive for a while, just like they were after 08, 09. It took a while for middle market businesses to come back and for confidence to come back. I think you're going to see the same thing if this really drags out for another couple of years, which it might. They're going to want to see how you handled it, what it did to your business, and how you adapted, and what and if you could adapt, quite frankly. So I think that's a great point. Documenting that and is going to be very important if you do want to exit.
Yeah, and I think Andy's going to have a COVID EBITDA add back.
Absolutely, the more the better. Well, they're all legitimate too. I can tell you that.
Okay. Another question we have is, do you think earnout structures will be more common, and how can sellers position themselves to avoid the potential negative impact for the earnout?
I think they will be more common. Like we mentioned, maybe not as common as I would have thought a month ago, especially if the business is doing okay. Again, it's a supply and demand thing. I think you're going to have a lot of businesses. There are very few businesses for sale and a lot of buyers out there. But if they're maybe the business is not, it went through February, March, April, May, and it hasn't bounced back. Let's say we're, early 21 or later this year. It's come back, but maybe not all the way. But the business owner thinks it's going to. Buyers aren't convinced. You're absolutely going to see more earnouts. Nikki, what was the second part of that question?
And how can sellers position themselves to avoid the potential negative impact for the earnout?
Keith, you want to touch on that one? Let you handle that.
Yeah, I mean, I would just I would echo your comments. Just that I think many buyers are going to look at the March, April, May time period, and if you've not bounced back, they'll probably evaluate closing on a TTM basis and then putting the balance of that in an earnout based on achieving kind of pre-COVID levels. I would expect. In terms of positioning, I think like on the last question, just documenting and providing as much analytical support to show this is what happened to my business and this is how I reacted and this is the outcome.
Yep.
Another question. I'm thinking of selling my business, but I'm not in a hurry. Should I take it to market this year or hold off for a couple of years?
That's a great point or a great question. I think that if you're a seller and you can prove that you're back to quote unquote normal or maybe even better than normal for a few months, maybe you were impacted for a couple months or maybe you weren't at all, which we've seen a number of businesses are actually doing better, e-commerce related, or there's a number of variety of businesses are actually doing better. If you can show that, then absolutely, you should probably look to go to market because there's not much competition out there amongst other sellers and a whole lot of buyers looking for deals. If you don't think it's going to get back to kind of a normal run rate in the next 6 to 12 months, it may make sense to hold off because that there's going to be a lot of questions buyers are going to have still if you can't kind of show, hey, we've got a backlog of orders, or maybe the business has declined and is not coming back, then yeah, you might have to hang around to get the max valuation. You might have to hang around for a couple more years.
Yeah, I would totally agree. I mean, it's going to be how your performance has been over the last 3 months, and then the outlook of that performance. And I'd say if you've got a good crystal ball in your business and you can see kind of a good growth trajectory and can demonstrate that, I think those businesses are going to provide kind of the premium or command the premium price in the market. And absolutely, I would consider, especially now, as deal flow picks up, if you're kind of one of 100 versus one of 500 deals, you just get that much more attention and create much more of a strategic kind of valuation impact.
Yeah, I mean, we've got a couple of transactions where companies that are clients that are doing well, or they've got a window to see and they can prove it that, hey, we just got delayed with some orders, but things are blowing and going again. It's probably a good time to go to market, because I think you're gonna get a lot of interest out there. Any more, Nikki?
One final question: is now a good time to be a buyer or begin an acquisition strategy?
I guess it, again, probably like the seller question, depends a little bit. If you're in an industry that's maybe having some struggles, if you know of companies that are going to sell and probably take a lower valuation, and you've got more of a 10-year, 20-year time horizon, I'd say yes. It's probably a good time to get into the market, because keep in mind, deals don't close overnight, right? It's going to take you 6, 9, 12, 18 months if you started looking today to close the deal. So yes, if you've got a kind of a long-term acquisition strategy, it's probably a good time to get out there. There's a lot of things. I mean, Keith can comment too. If you've got a good bank relationship, if you've got availability to get some debt, if you've got some cash, yeah, it's probably a good time to get out there and start looking.
Yeah, I completely agree. I would, if you're in a good industry with some solid fundamentals, or even not, there's an opportunity right now. And I think, Andy's buy side services would be great, just as you think about consolidating, a particular industry. I would absolutely, if you're at all thinking about it, explore those conversations in greater detail.
Okay, doesn't look like we have any other questions coming in. Andy and Keith, if you have nothing else to add, I just want to say thank you for the presentation today. I am going to, actually, this session has been recorded, so I want to make sure everyone gets a copy of it afterwards, as well as the copy of the slides. But before we go, I'm going to kick things off to Joe Beckman for a couple of quick wrap-up announcements. Joe, are you on?
Yeah, Nikki, thank you very much. So as Nikki mentioned, I'm Joe Beckman. I'm a partner with the law firm of Baker Hostetler here in the Columbus office. Want to start by thanking Andy and Keith for sharing your time and expertise today in a very uncertain and fluid market. So we appreciate your thoughts in those regards. Normally, this is the time where we would give you a token, a gift, a token of our appreciation for your time. I am, holding a virtual blue bag from the Diamond Cellar for you, which has virtually nothing in it. So thanks for that. I want to thank all of our attendees for participating in the ACG Columbus webinar here today. And just want to give a couple of notes on 2 upcoming events. One is our Women in Transaction doing a virtual networking event on Wednesday, July 18th. And there is a joint Young ACG and ACG webinar featuring panelists from Ant Flow, Homage, and Watershed Distillery on Tuesday, July 28th. More information and registration can be found on the ACG Columbus website. We want to say a special thanks to all of our annual sponsors that make our program possible. And if you have any questions about membership or events, you can always reach out to Nikki Glenn at acgcolumbus@acg.org. And thanks for everyone, and please stay well and healthy.
Thank you.
Thanks, everyone.